The silver crash is doing its job because the screen price is collapsing while the real world price signal is getting louder, and the people who only watch candles are about to get played by the oldest trick in a thin market. There's a force in every leveraged market that benefits when you confuse liquidation with truth. Not a cartoon villain. Just incentives. Risk desks that need volatility to flush leverage. Funds that need liquidity to rebalance. And market makers who widen spreads when the books go ghost. And here's the hidden detail most people miss. When price is lying, the spread tells the truth. Not your favorite influencer. Not the headline. The gap between paper and physical and the places where metal actually clears. Stay with me. Because by the end of this, you'll have 3 levels that matter. A 2-scenario roadmap for the next 1 to 2 weeks. And the single metric that tells you whether this move is just a shakeout or the setup for the next vertical leg. And that's where the real pressure starts. What you're watching right now is a market that just came off an historic run. Silver ripping through 2025, printing an all-time high in the low to mid-80s earlier this week, and then snapping back fast into the low to mid-70s as we kick off the first trading days of 2026. That speed is not normal price discovery. That speed is leverage getting repriced. Silver didn't randomly fall. It transitioned from everyone wants in to everyone needs collateral in a matter of hours. But that's not the part that matters. The part that matters is what didn't fall with it. The physical bid in places that actually need metal, the regional premiums that refuse to die, and the term structure behavior that tells you whether supply is truly loose or just temporarily being masked by forced selling. Because if this one level breaks, the math changes. Now let's talk about the trap in your title, because Ghost Week is a real thing, even if nobody calls it that on the institutional side. This is the stretch where liquidity thins, dealers run lighter risk, books are still repositioning after year-end, and every move gets exaggerated because there's less depth to absorb it. Early January is famous for 2 behaviors that can both be true at once: fresh inflows and violent stop runs. People come in with new allocations, but market makers and risk desks also know it's easier to move paper than it is to move metal, and it's easier to shake out weak hands when the tape is jumpy and the headlines are loud. When the market is thick, a big order gets absorbed. When the market is thin, a big order becomes a story. And stories trigger stops. Stops trigger margin calls. Margin calls trigger forced selling. Then forced selling becomes the evidence everyone uses to justify the story. That feedback loop is the Ghost Week trap. And the next detail is what flips the whole setup. Because the catalyst here wasn't just profit taking. A key accelerant in late December silver volatility was changes in futures margin requirements. When an exchange raises initial or maintenance margin, it's not a moral judgment, it's a mechanical tightening of credit. You can be right on direction and still get liquidated if your collateral math changes overnight. If you're holding leveraged longs, a margin hike means you either post more cash, reduce your position, or get cut. If you're a fund that's already up huge for the year, the rational response is to de-risk. If you're a retail trader or a smaller shop, you often don't have a choice. And here's the ugly part. That de-risking tends to happen into thin liquidity windows, because that's when gaps form. It looks like the market knows something. But often it's just collateral being repriced. And that's where the real pressure starts. So when you see silver slam toward the mid-70s after printing in the 80s, don't immediately translate that into demand disappeared. Translate it into leverage got squeezed. That's the first layer. The second layer is market structure. A futures contract can be sold in a second, but a physical supply chain can't be rerouted in a second. Paper can crash fast, metal can't. That mismatch is where distortions are born. Futures are a price discovery mechanism, yes, but they're also a leverage mechanism, and leverage does violent things when the rules change. Meanwhile, physical markets are slower, stickier, and full of friction. Assay, bar specs, location, taxes, shipping, insurance, working capital, and time. When those frictions are high, the screen price can detach from the get me the metal now price. And that brings us to the line in your title that makes people either roll their eyes or lean in. Silver crashes to $75, but China is paying $89. If you hear that and your brain immediately screams conspiracy, pause. You can get huge gaps with boring ingredients. Onshore pricing can reflect VAT, delivery conditions, currency conversion, and immediate scarcity. And yes, sometimes it also reflects desperation. But the point isn't whether $89 is the exact number in every print. The point is the direction. A premium exists, and premiums are a real signal. They're the spread telling you the truth. But that's not the part that matters. The part that matters is why that premium doesn't instantly get arbitraged away. In a frictionless world, if one region is paying $10 more per ounce than another, metal would flow until the gap closed. So when you see a persistent premium, it's telling you arbitrage is constrained. It's telling you there are bottlenecks, logistics, financing, regulatory limits, bar formats, delivery lead times, or simply the fact that the metal that exists isn't the metal that can be delivered where it's needed, when it's needed. And that's where the real pressure starts. Let's make this concrete without pretending we have magical perfect data. Physical silver pricing in Shanghai can trade at a noticeable premium to COMEX-linked paper prices when industrial buyers and onshore investors are bidding for immediate availability, and when moving metal into that market isn't instantaneous. Even if you can buy a futures contract in New York at a lower implied price, you can't teleport bars to a factory schedule. You can't instantly clear customs. You can't instantly secure freight, insurance, and financing. You can't instantly turn eligible inventory into deliverable inventory in the exact location and form required. And that inventory distinction matters more than most people realize. In futures warehouses, there's a difference between metal that is registered for delivery against contracts and metal that is merely eligible, present but not committed. In a stress moment, only deliverable inventory calms the market. It exists somewhere is not a solution to a near-term delivery window. If deliverable stocks feel tight, the curve can start to signal it. Nearby contracts can hold up better than far-dated ones. Lease rates can move, premiums can widen, retail availability can tighten. Those are the street symptoms. And that's how you know the sell-off might be paper-driven rather than demand-driven. But here's the twist. Paper-driven sell-offs can still become real. Because when paper dumps hard enough, it can scare the marginal physical buyer, delay procurement, and temporarily relieve pressure. That's why this setup is a knife fight. And that's why you need a roadmap. Because if this one level breaks, the math changes. Let's talk chart structure, because technicals matter here, not as voodoo, but as a map of who is forced to act at what price. After a near vertical push into the 80s, the market created a supply zone where sellers finally had enough incentive to lean. Call it roughly the high 70s up through the low 80s. Exact levels will vary depending on the feed. That zone matters because it's where late longs entered and where shorts got hurt. When price snapped back into the low to mid 70s, it didn't just drop. It crossed into a range where a lot of positions are underwater. That's why bounces get sold and dips get bought in violent alternating waves. Shorts see relief and press, longs see discount and try to re-enter. Market makers see high implied volatility and hedge aggressively. And this is where options mechanics can matter even if you never trade options. As price swings, dealers adjust hedges. In certain zones, that hedging can amplify moves, buying into rallies, selling into drops, depending on positioning and gamma exposure. You'd on a T need the full math to understand the effect. When volatility spikes and liquidity thins, hedging flows can become the tail that wags the dog. And that's where the real pressure starts. Now stack the proof, because we're not doing one argument hopium. Proof point one is the calendar itself. The first week of January, after a massive year-end run, is when rebalancing and risk management collide with thin liquidity. That's your ghost week trigger. Proof point two is margin and collateral dynamics. If margin requirements rise into a market that just went vertical, you get forced deleveraging. That creates crash candles that are not pure sentiment, but mechanics. Proof point three is the persistence of premiums and regional gaps. Even a moderate premium in a major physical hub is a sign that immediate delivery is valued more than the screen price implies. Proof point four is the inventory reality. The market cares about deliverable metal and timing, not abstract global stockpiles. Proof point five is term structure. If nearby tightness remains while the headline price whips, that's a signal of supply chain friction. Proof point six, because we're stacking layers, is institutional behavior. After a monster year, funds lock gains, reduce risk, and rotate, especially if they suspect volatility will be used as a weapon against late entrants. That behavior creates air pockets. It doesn't negate the longer-term thesis, but it can torture you in the short term. And that is the point. Volatility can be maximal at the exact moment the fundamental story is strongest, because that's when the biggest leverage is present, and that's where the real pressure starts. Now we address the China paying more angle with adult language. It's not China versus the West as a meme. It's a set of microstructures. Shanghai is not New York. Onshore markets operate with different participation, different constraints, and different urgency. Industrial demand there can be less price sensitive in the short run because production schedules punish shortages. If a manufacturer needs silver inputs for electronics, solar components, or specialized alloys, a delayed shipment can cost more than a higher purchase price. That's how premiums are born. Add frictions, tax, logistics, funding, regulatory steps, and you can see a persistent gap. But don't romanticize it. Premiums can also collapse quickly when shipments arrive, when demand pauses, or when credit tightens. That's why you don't worship one metric. You watch it. You watch whether the premium widens when price dips. You watch whether it stays elevated through a sell-off, because that's the tell. If the premium holds while the screen price dumps, you're watching paper get slammed while physical stays bid. If the premium collapses with the screen price, you're watching demand actually step back. That's a critical difference. And that is the hidden detail that reframes the entire story. The spread is not a footnote, it is the scoreboard. Because if this one level breaks, the math changes. Now let's talk about the emotional manipulation. Because if you don't armor your psychology, the market will use you as liquidity. Silver is built to mess with you. It's volatile, it gaps, and it has one of the nastiest personality traits of any major commodity. It can be right on fundamentals and still rip your face off in both directions. That's why it is such a powerful transfer to market. Wealth moves from impatient hands to patient hands through discomfort. And in thin weeks, that discomfort is engineered by structure, not by a secret cabal. The structure itself does it. Here's how. Big moves create headlines. Headlines create narrative certainty. Narrative certainty creates late positioning. Late positioning creates crowded leverage. Crowded leverage creates fragility. Fragility creates margin stress. Margin stress creates liquidation. Liquidation creates more headlines. And the cycle renews. Your brain gets pulled into the story at the worst possible time. You see red candles and you feel danger. You see green candles and you feel opportunity. That is the emotional loop the market feeds on. Your shield is simple. Separate trend from noise. Trend is what happens across weeks and months with confirmation from spreads, inventories, and term structure. Noise is what happens in a day or two when liquidity is thin and leverage is getting reset. If you don't separate those, you will sell the noise and buy the noise, and you'll swear the market is rigged, when it honestly really your nervous system being exploited by volatility. And that's where the real pressure starts. So what do you do with this information without pretending it's a guaranteed trade? You build a two-scenario lens. Scenario 1 is the controlled pullback and retest. In this scenario, the market uses the mid-70s as a basing zone, chops violently, and then starts to reclaim key levels as leverage resets. You'll see stabilization. Down days get bought, spreads stop widening aggressively against you, and the premium, if it exists, holds firm or even strengthens on dips. The curve may remain relatively tight. Price may start to build higher lows. This scenario is maddening, slow, and full of fakeouts, but it's constructive. Scenario 2 is the continuation squeeze after the shakeout. In this scenario, the crash was the flush, not the top. Price snaps back faster than people expect, reclaims a key reclaim zone, think the upper 70s first, then the psychological 80 handle, and once it does, the market forces hedgers and shorts to respond. If short exposure is still present, you can get violent upside as risk desks scramble to neutralize. In this scenario, gap risk is to the upside, not the downside. The rallies are fast, the pullbacks are shallow, and the people who got shaken out chase back in at worse prices. That's how silver does it. But here's the discipline. You don't marry either scenario until the tells confirm, and that's where the real pressure starts. Now let's define the what to watch next checklist in a way that doesn't require you to be a professional. First, watch the level that the market treated as a trap door during the sell-off, the low to mid-70s zone. If price repeatedly rejects below it and can't hold, the market is telling you the flush is still ongoing. If it holds and starts to build a base, that's stabilization. Second, watch the first reclaim zone above, roughly the upper 70s. If silver can reclaim and hold that area on a closing basis, you're seeing strength return. Third, watch the major psychological zone, 80. Markets love round numbers. If price can break above and stay above, the narrative shifts from crash back to trend. But price alone is not enough. The real tells are the side channels. Watch the physical premium behavior in key hubs. You don't need perfect data. You need direction. Is the premium staying elevated while futures are weak? That's supportive. Is it collapsing? That weakens the thesis. Watch the curve and spreads. Are nearby months staying relatively bid compared to later months, suggesting immediate tightness? That supports the physical stress angle. Are things relaxing into contango with ease? That suggests supply is not urgent, at least for now. Watch ETF and institutional flow behavior if you follow it. Do holdings stabilize after the shakeout, or do they bleed? Stabilization is constructive. Persistent outflows are a headwind. Watch macro conditions, dollar strength, real yields, risk-off events. Silver is not a pure safe haven. It's part industrial, part monetary. In risk-off panics, it can drop with everything. That's why you respect volatility, even if your thesis is right. And that's the point. Price can whip around violently, even if the big picture is intact. Noise can hurt you while trend remains true. And that's where the real pressure starts. Now let's talk about the suppression language without getting dumb about it. Markets don't need a secret meeting to create a suppression effect. They just need concentrated leverage and incentives. If a lot of paper is traded against a relatively smaller pool of deliverable physical, then short-term price can be steered by paper flows. That's not illegal by definition. It's a function of market structure. The question is not, are they suppressing it? The question is, does physical push back? and physical pushes back through premiums, spreads, and delivery stress. If physical demand truly tightens, paper can only ignore it for so long. Arbitrage and delivery mechanisms drag the screen price toward the real clearing price over time. But in the short run, paper can absolutely bully the tape, especially in ghost week conditions. That's the trap. The mainstream will point to the crash and declare the move over. The spread will quietly tell you whether the move is actually building tension. But that's not the part that matters. The part that matters is the why now calendar trigger beyond just early January. You're also sitting near a period where positioning is freshly reset and where funds set new risk budgets for the year. That creates a unique environment. Large players are willing to put on size again, but they want better entry and they want weaker hands gone first. If you wanted to design a perfect shakeout, you would do it after a vertical run in a thin week with a margin shock in the background. When everyone is emotionally primed to believe the top is in, and that's exactly the recipe you just watched. And that's where the real pressure starts. So what invalidates the bullish, paper flush, physical tight story? Let's be specific, because credibility lives in invalidation. If the physical premium that everyone is talking about collapses and stays collapsed while the screen price stays weak, that's a sign the real-world bid stepped away. If the curve loosens materially, nearby prices stop showing urgency, spreads stop signaling tightness. That suggests supply pressure is easing, at least temporarily. If price loses the low 70s zone cleanly and cannot recover it, especially with heavy volume and no bounce, the market may be telling you the deleveraging is deeper than a shakeout. If macro conditions turn sharply against commodities, real yields spike, dollar surges, broad risk assets dump, silver can get dragged even if physical demand is fine. In that world, you can still have a long-term supply story and a brutal near-term tape. That's why time horizon is everything. The same chart can be a buy the dip for a multi-month view and a do not fight this for a short-term leveraged view. If you confuse those horizons, volatility will chew you, and that's where the real pressure starts. Now flip it. What confirms the bullish setup? Confirmation looks like this. The market flushes into the low to mid-70s and refuses to break lower despite bad headlines. Dips get absorbed quickly. Premiums remain sticky. Any reported tightness in physical hubs persists rather than vanishing. Price reclaims the upper 70s and begins to hold it. Then you watch the response around 80. If silver starts to reclaim and consolidate above 80, the psychology flips. Shorts get cautious, hedgers adjust. Momentum re-enters. And in a market with recent all-time highs, reclaiming prior resistance can trigger reflexive buying. Not because of magic, but because risk managers and systematic strategies respond to level-based signals. If that happens, the next upside test becomes the recent highs in the low to mid-80s. And if those highs are taken with conviction, you're back in price discovery, where moves can extend beyond what feels reasonable. That's the squeeze scenario. But here's your adult reminder. None of that is guaranteed, and silver can absolutely whipsaw both sides. The goal isn't to predict perfectly. The goal is to avoid getting emotionally harvested, and that's where the real pressure starts. Let's do a quick pattern interrupt, because numbers help anchor reality. If silver rallied from roughly the low 30s a year ago to the low 80s recently, that's more than a double. In any market, that kind of move builds leverage. Leverage is like dry brush in a forest. It makes the next move violent. A margin change is like a spark. A thin week is like wind. That's why you got a crash-style candle even in a market with a strong story. And here's another interrupt. The China paying $89 headline is emotionally designed. It makes you feel like you're missing out, or like the system is lying, or like you need to do something right now. That's the psychological hook. Don't let it force impulsive decisions. Use it as a lens. If there is a persistent gap between onshore physical and offshore paper, you don't chase the headline, you monitor the gap. If the gap widens while price dumps, that's tension building. If the gap collapses, that's tension releasing. Simple. And that's the hidden detail most people miss. Because if this one level breaks, the math changes. Now, where do institutions fit into this without turning it into a conspiracy movie? Institutions are not a monolith, but they do share behaviors. After a massive year, they protect gains. They reduce exposure when volatility spikes. They rebalance. If silver became overweight in portfolios due to performance, funds may sell simply to restore target weights. That selling is not bearish information, it's policy. Meanwhile, industrial buyers often do the opposite in dips if they fear future scarcity. They use weakness to secure supply, especially if their procurement teams are judged on continuity, not on timing the perfect low. That creates the tug of war. Financial flows can dump paper, while industrial flows quietly absorb physical. The price you see depends on which arena dominates in the moment. In Ghost Week, paper often dominates the tape. Over the next weeks, physical can reassert itself if tightness is real. That's why your roadmap is about watching the tells, not worshiping the candle. And that's where the real pressure starts. So here's the near-term expectation set, without pretending certainty. Over the next 1 to 2 weeks, expect volatility to stay elevated. That's not bearish or bullish by itself, it's the environment. In a controlled retest scenario, you'll see choppy sideways action with violent intraday swings, and the market will try to shake you out multiple times. The trap will be convincing you each dip is the real breakdown, and each bounce is the real bottom. Don't do that. Anchor on levels and confirmations. In a continuation squeeze scenario, the market will reclaim key zones faster than feels comfortable, and the trap will be convincing you it already ran, don't chase, right before it runs again. That's how squeezes feel. They feel unfair, and in both scenarios, the market's favorite trick is to punish the maximum number of people. That means fake breaks below support, then ripping higher. Or fake breakouts above resistance, then slamming lower. Your defense is to know what invalidates your view and size your exposure to survive noise. Because if you can't survive the noise, you don't get to participate in the trend. And that's where the real pressure starts. Now I'm going to give you the cleanest watch list version of this in plain language. Watch the low to mid 70s. That's your battlefield. Hold and base there, and the flush starts to look like a reset. Lose it cleanly and stay below, and you respect the possibility of deeper deleveraging. Watch the upper 70s. That's the first reclaim gate. Get above and hold, and the tape begins to heal. Watch 80. That's the psychological flip point. Above 80 with strength, and the market starts thinking about the highs again. At the same time, watch the spread story. Do premiums and physical signals stay firm during weakness? That's your price is lying confirmation. Watch curve behavior. Does near-term tightness persist? That supports the physical tension narrative. And watch macro. If rates and the dollar are smashing commodities, don't be shocked if silver gets dragged even if the physical story is intact. That's the reality of a metal that lives in two worlds. And that's where the real pressure starts. Finally, the quiet warning. The one that separates people who survive silver from people who become liquidity. Volatility will be used against you. Not because someone hates you, but because volatility is a profit engine for the structure itself. It forces turnover. It creates spread. It triggers forced behavior. If you chase green, you buy tops. If you puke red, you sell lows. The market doesn't need to beat you. It just needs you to beat yourself at the worst moments. So pick a horizon, define invalidation, and refuse to let a thin weak candle rewrite your entire thesis. If you're here for macro and supply tension, then your focus is the spread, the curve, inventories, and policy signals, not one scary day. If you're here to trade short-term, then respect margin and liquidity, because silver will humble leverage faster than almost any mainstream asset. And that's where the real pressure starts. If you want a calm, identity-based way to stay sharp through this without getting whipped out by emotion, keep it simple. Be the person who waits for confirmation, who reads the market's plumbing instead of the headlines, and who survives long enough to be right. If you're watching this because you're tired of being baited by narratives, you're in the right room. Drop your key level and which scenario you think we're in, controlled retest or continuation squeeze, and we'll compare notes as the tape prints.